Hello, this is Brian Belsky, Chief Investment Strategist at BMO Capital Markets. We recently published our 2023 year-ahead market outlook for the U.S. Frankly speaking, 2022 was a year we would like to forget, but good comes from everything, with the adaptability, stability, and fortitude of U.S. stocks defining a much-needed and very positive normalization process, with a return, by the way, to positive equity market returns as a likely outcome. Therefore, let the normalization process begin. In other words, the days of liquidity-induced gains are likely behind us. So what does normalization actually mean? In our view, when it comes to the world of investing, a path to normalization encompasses a lot of things, including, but not limited to, stock market returns, earnings growth, valuation, interest rates, inflation, and economic growth. However, this process is not likely to occur overnight, with 2023 representing year one of a multi-year trend. Think of it more as a marathon than a sprint, especially given the momentum and reactionary-driven strategies of the past few years. That does not mean that our 20 to 25 year secular bull market call is no longer valid. To the contrary, secular bulls can endure down years like we had in 2022, let alone flat years. As such, our 2023 forecast for an S&P 500 index year-end price target of 4,300 on earnings of $220 is aligned with this thesis. In other words, mildly higher price levels than where stocks will close in 2022. However, the changing market dynamics are sure to cause more angst than clarity, especially as normalized interest rates and inflation remain at much higher levels than most investors have ever witnessed, let alone persistent recession fears. Therefore, investors should be prepared for a Jack be nimble, Jack be quick environment and consider deploying more of a stock picking and active investing portfolio strategy. That being said, we still believe the U.S. stock market remains the best equity asset in the world, with non-U.S. investors increasing their U.S. exposure given the relative and absolute fundamental strength and stability. In terms of sectors, we favor communication services, financials, and healthcare in the U.S. Our neutral discretionary energy, industrials, materials, and REITs, and technology, while advising clients to underweight consumer staples and utilities. Furthermore, we prefer value over growth in small mid-cap companies relative to large-cap stocks. Thanks so much for joining us. Here's to a better and more normal 2023.